Many businesses fail simply because they do not have a good enough understanding of where the cash in the business comes from and goes to, and as a result they run out of money. In this session we'll be exploring the range of financial issues that affect the small business, and we'll look at how you can apply this insight to develop a viable financial model for your own business idea. So the aim of this session is to provide an understanding of finances that applies to business and your business model. And we're also looking to build an awareness of the importance of financial resources. And the two main financial resources to consider here are profit and cash. During this session we'll explore the role and relative importance of both. We'll also examine what financial documents look like, and for many new business owners there can be genuine fear and confusion when they first approach financial documents. So here we'll gain a basic understanding of what financial documents are, what they do, and how they can be used to help manage the business. Next, we'll provide an opportunity to gain some practical experience of working with cash flows. And these are a basic business tool, and the more time you spend using this tool, the better you'll become at using them. And lastly, we'll highlight the problems in managing the finances of a business, and we'll demonstrate that financial projections can provide the owner of a business with a valuable tool for highlighting possible problems in the cash flow of the business in order to come up with potential solutions before they adversely affect the business. So in summary, I'm going to firstly explain some of the core concepts around entrepreneurial finance, and then I'll walk you through step by step the process of how to apply this knowledge to build your own financial model using the financial spreadsheet template. Now, the term financial projections is often used in business to describe a collection of financial documents which have been prepared in order to estimate the potential income and expenditure for a specific business. Now, this business may be new or established, and over a specific period of time, generally 12 to 36 months, although it could be longer if required, we're looking to make some forecasts about how the business might perform. The financial documents themselves are usually developed using a spreadsheet template, and there are countless examples which can be accessed freely online. And financial projections are usually prepared to obtain some form of support, such as investment in the business. The three most important financial documents which we'll be focusing on here are the cash flow, the profit and loss account or the P&L, and the balance sheet. So to start, consider this question: which is more important, profit or cash? Cash is important as it is essential in order to run the business on a day-to-day operational basis. Problems with cash are immediate and critical, and any business, however large, can encounter cash flow problems for a variety of reasons at any time, such as poor credit control, poor management of inventory, or simply unforeseen additional expenses which have not been budgeted for. But profit is also important, as this is a surplus we need to generate in order to reinvest and develop and grow the business. Problems with profit emerge over a longer period of time, and this can be linked to issues such as incorrect pricing strategy, poor sales, and excessive levels of wastage. A business can make a loss but still trade on if it has reserves of cash, and all businesses generally try to retain some extra cash or capital in reserve in order to cover themselves against unforeseen expenses which could affect the business's cash flow. We call this operating capital. On the other hand, a business can make a profit, but if it runs out of cash, it's out of business. Most businesses have a range of fixed costs which are simply expenses which are incurred regardless of any sales. An example of this would be business insurance. They'll also have a range of variable costs which are expenses linked directly to the sale, such as food purchases for a catering company. If a business is trading but does not have enough cash to meet operating expenses, it is deemed to be insolvent, and sooner or later it will be forced to cease trading. So clearly profit and cash are equally important, but for very different reasons. A business needs to consider how best to generate both profit and cash, and most business owners in the early stages tend to be preoccupied with making sales and they forget about generating profit. Often they'll take work which will generate revenue but which leaves little or no surplus, or may even cause the business to lose money. We call this a loss leader, and loss leaders are rarely a good idea and can have a really bad effect for the business in the longer term. The importance for the business owner of generating both cash and profit cannot be overstated. So let's take a closer look at profit, and we can start by considering this question: how do we make more profit? Well, here there are three main ways in which the business can increase its profits, and the first of these is to raise prices. Generally, new businesses tend to undercut the market rate, either intentionally as part of a strategy to secure a share of the market, or unintentionally as a result of a failure to research the market properly to identify the going rate for a product. In either case, there's disconnect between the price being charged and the market rate. The price at which most established like-for-like competitors will gravitate to needs to be addressed quickly if the business is to be profitable. So basically, most new businesses instinctively do not charge enough for their products or services, so usually there is clear scope to increase prices. The next way we can increase profits is to simply sell more products or services, and for this we need to assume that the business model is actually profitable to start with, i.e. when trading normally it generates at least a small surplus, therefore selling more products will generate a higher level of profit. If the business is operating at a loss, then clearly selling more products will only get the business into deeper trouble more quickly. Lastly, we can raise profits by reducing costs. Reducing wastage or sourcing cheaper sources of supply can significantly raise the business's profit level. It's important to understand here that relatively modest improvements in each of these areas, such as a slight increase in price, plus a slight increase in sales, plus a slight reduction in cost, can have a dramatic impact on the business's profit level. So now we need to finalise our pricing strategy, and remember that, as is shown in this short video, there are a number of tried and tested pricing strategies which you can apply to your business, each with their own implications for your margin, and it is vital that you adopt an appropriate strategy for your business model at the right time. It's also important to recognise that businesses often adopt different pricing strategies for different products, or at different times of the year, or at different stages of the business's development. For example, a business who would expect to do poorly in January might logically offer a discount for that month, and a business which is just starting up should always be competitively priced, although the temptation to undercut should be avoided at all times. So now I'm going to walk you through how to use the financial spreadsheet template, and this template has been developed over time by industry experts who use business plans to assess the viability of a business model on a daily basis. When using the template, the cash flow is where most of the financial information will be entered directly. The yellow sections contained in the spreadsheet have been coloured to help you enter the data in the correct areas and limit errors. The column on the far left of the cash flow is a series of key headings which allow you to enter figures in the most appropriate place. You should find that there's a suitable heading for all your potential income and expenditure, so avoid changing the headings in the left-hand column unless you really need to. Any costs which do not have a logical place in the left-hand column should go in under the sundries heading. Sundries are simply miscellaneous expenses which do not fit anywhere else. But please note, when you're making changes to the spreadsheet, do not delete the contents of any cell, as this will also delete the formula contained within the cell. Instead, simply overwrite the number that you wish to change. So let's look first at the seasonal aspects of the business. Now, seasonality is extremely important for a business owner to consider, and the time of year at which they start the business can be critical to the business's ultimate success or failure. Changing the months on the spreadsheet allows you to select a logical time for your business to theoretically start, and you can change the months by overwriting the months on the template manually here. When doing this, it's important to consider in real terms the types of barriers that the owner might encounter that could logically be expected to delay the start of the business, such as obtaining funding, refurbishing premises, or obtaining any licenses that you might need to operate. The time frame chosen to start the hypothetical business must be realistic, so there's no point stating that you could open, for example, a new restaurant in 3 months, when the barriers to this type of business are likely to be significant and could lead to lengthy delays. The next assumption we need to make relates to the cost of materials or purchases used whenever you make a sale. Purchases relates to any stock consumed when you make an actual sale, and it should be expressed as a direct percentage of that sale. So for a flower shop, we're talking only about the flowers and any packaging used to make the sale. This can be very difficult to estimate, mainly because unless you've actually set up this type of business, suppliers won't really be inclined to talk to you about pricing, and it's difficult to negotiate a good deal for a business which is hypothetical. The main things though to think about here are as follows. Firstly, you need to research the market, and you can try some mystery shopping to speak to your potential competitors to see if you can work out from their prices what your materials cost might be. You also need to make a decision about the quality of the materials you would use and decide on what your pricing strategy will be. For example, are you going to be using premium or budget pricing, as this will impact on your purchase costs. You also need to look at real suppliers' pricing, and this should give you a clue as to what they might be paying. Generally, established competitors in the market tend to charge similar prices, whereas new businesses tend to try to undercut their established competitors to try to quickly get a share of the market. And lastly, if you're in any doubt, you should err on the side of caution. Overestimate your costs and underestimate your sales, and in doing so you'll build an element of caution into your business's financial model. So if we return to our coffee shop example, we need to think about how much of the £3.50 the customer might pay for a large coffee would actually be spent on the stock used to make the coffee. And in this case that would be the coffee itself, the milk and the sugar that went into it, and the cup the coffee actually went into, which is also part of the overall product. So that's purchases, but we need to also think about stock. On the cash flow, stock should be viewed as being different from purchases. You should think about stock only as the opening stock you need to buy in order to start trading. It then becomes the minimum level of stock you'll always have in the business under normal circumstances. So let's now think about loans. If you're intending to borrow money to start a business, then you'll need to complete a loan calculation. Borrowing money in the form of a loan is very common in business. The loan itself could be from a friend or a family member, or from a commercial lender such as a bank. But the principle is still the same. Using the spreadsheet, the loan calculation is made by entering three factors in the boxes highlighted in this slide. The loan amount, whatever sum you are borrowing, the interest rate, which is determined by the lender, and the term of the loan in months, normally between 36 and 60 months for a startup business. The spreadsheet will then automatically calculate the loan interest and the capital payment once you've entered these three numbers. Whilst you can take out a loan and pay it off earlier or later, generally you want to strike a balance between keeping the payments low enough to manage whilst also keeping within a sensible time frame. For example, there's no point taking a loan out over 5 years for a piece of equipment that will only have a lifespan of 3 years. In that case, you would logically take the loan out over 3 years or 36 months. The cash flow is one of the core financial documents found within a business plan. The financial documents together form the financial projections for the business model, and these are normally contained in the business plan in the appendices section, and you'll refer to them throughout the narrative of the business plan. The financial plan is a vital part of your business plan. It's where all the assumptions and evidence are tested. Cash flows can vary to some degree in appearance, but generally they follow a given style with income at the top and expenditure at the bottom. The spreadsheet template which we'll be using manages all the calculations automatically. Some of the key elements of the cash flow have been highlighted as follows. Firstly, we've got total sales, and this is the income derived purely from selling goods or services. Next, we have operating capital, which is cash in the bank that the owner has to work with on a day-to-day basis. Then we have total income, which is made up of total sales plus any other sources of income, which is generally grants or loans at the startup phase. We can also see startup costs, which relates to capital expenditure made before the business starts to trade, usually for things such as equipment, stock or vehicles. And also we've got cash in bank, which is literally what is in the business bank account from 1 month to the next. A negative balance here would create a requirement for a bank overdraft or some other injection of capital. And another important element is startup funding, which is the funding package required to start the business. It includes things like grants, loans and owner's investment in cash and in kind. The profit and loss account is sometimes referred to as a P&L, and it's another of the key financial documents which would normally be contained in a business plan. The profit and loss shows what profit or loss has been made at the end of a specific financial period. This is normally a financial quarter or a financial year. From earlier sessions, we'll remember that there are a few levers which we can use in order to influence the amount of profit a business makes. We can increase the price of our products and services, reduce the business's costs, or sell more. There's no need to enter any information directly into the profit and loss, as it automatically is generated when you populate the rest of the spreadsheet, so do not change any of the numbers in the P&L. The balance sheet is also one of the key financial documents contained within the business plan. Basically, the balance sheet is a snapshot of the business at a fixed moment in time, usually at the end of a financial period, in our case 12 months. The balance sheet is where you can see how the capital within the business has been employed. In other words, this is where you can see where the money has all gone. In addition to assets or things of value to the business that you can see in touch, such as cash, vehicles and equipment, you'll also find here details of any liabilities which the business has, such as loans outstanding. The balance sheet is also populated automatically when you input financial data on other pages of the business startup spreadsheet, and again, do not make changes to the balance sheet directly. The break-even shows how much the business has to make from sales before it turns a profit. It is the point beyond which the business makes its first yen, dollar, pound or euro of profit. The break-even figure for any business model needs to be realistic and achievable. It is a good indicator of whether or not a business model is viable. If the volume of sales a business needs to make to break even seems very high, then the question should be asked, what can we do to make the business more profitable using the levers at our disposal? You do not need to memorise a formula for calculating break-even, but you should be able to recognise whether the break-even figure which comes out of the projections is realistic and achievable. The break-even is also populated from the financial data you input into other parts of the spreadsheet, so again, do not make changes manually to the break-even. The pre-start column in the financial spreadsheet template is the place to put all the untidy transactions that occur prior to the start of the business, including startup purchases and any investment in kind or in cash. Investment in kind covers contributions to the business that are not in the form of cash, for example, a van already owned by the business owner, which they then give to the business. This column could contain items that were purchased months or even years before the business is due to start, but the length of time involved is not important. What is important is that it's been brought into the business and that it is a tangible value to the business. The simplest way to decide what should or should not go into the pre-start column is to decide whether or not the purchase needs to be made prior to the business actually opening its doors to the customers or later. It's entirely normal for anyone using a spreadsheet for the first time to make basic data entry errors. The particular spreadsheet that we'll be using is a checkbox which you can find here. This exists simply to act as a check and balance and to help you find and fix any data entry errors. If there's any number in this box other than 0, then it's likely that a formula has been deleted or another error has been made. Generally, an error here occurs when you've done something unusual that is out with the normal scope of the spreadsheet, or if you've overwritten, altered or deleted a cell and therefore broken a formula. Where a formula error cannot be found or fixed, you should re-enter the basic financial data in a fresh spreadsheet, which will then be free from errors.